Welcome back to MythicVista. Today, we're diving deep into one of the most significant industries in the United States, real estate. Whether you're a first-time home buyer, an investor, or just curious about how this massive market works, this video will break down everything you need to know about the American real estate business.
The US real estate market is worth over $43 trillion, making it one of the largest asset classes in the world. But it's not just about buying and selling homes. This industry encompasses commercial properties, rental markets, real estate investment trusts, property management, and an entire ecosystem of professionals who make it all happen. So let's get started. First, let's talk about how the American real estate market is structured. Unlike some countries where real estate is heavily centralized or government-controlled, the US operates on a predominantly free market system with local, state, and federal regulations, creating a complex but dynamic environment. The market is typically divided into four main sectors. Residential real estate includes single-family homes, condominiums, townhouses, and multifamily properties like duplexes and apartment buildings. This is what most people think of when they hear real estate. Commercial real estate covers office buildings, retail spaces, shopping centers, and hotels. Industrial real estate includes warehouses, manufacturing facilities, and distribution centers, which have seen explosive growth thanks to e-commerce. Finally, land encompasses undeveloped property, agricultural land, and ranches. What makes the American system unique is its decentralized nature. Real estate laws, property taxes, zoning regulations, and even the buying process can vary significantly from state to state, and even city to city. This creates opportunities but also challenges for investors and businesses operating across multiple markets.
Now, who are the key players that make this industry function? The real estate industry employs millions of Americans and involves numerous professionals at every transaction. Real estate agents and brokers are the most visible faces of the industry. There are approximately 2 million active real estate licensees in the United States. Agents work under brokers and help buyers and sellers navigate transactions. They typically earn commissions, which traditionally have been around 5 to 6% of the sale price, split between the buyers and sellers' agents. However, this commission structure has been facing significant legal challenges and changes in recent years. Real estate brokers have additional licensing and can operate independently or manage their own firms. Major brokerages like Keller Williams, RE/MAX, Coldwell Banker, and newer tech-forward companies like Compass and Redfin employ thousands of agents nationwide. Mortgage lenders and loan officers are crucial because most Americans cannot buy property with cash. These professionals work for banks, credit unions, or mortgage companies, helping buyers secure financing. The mortgage industry itself is massive, with over $12 trillion in outstanding mortgage debt in the United States. Appraisers provide independent valuations of properties, which lenders require before approving mortgages. Home inspectors examine properties for structural issues, safety concerns, and needed repairs. Title companies ensure that property titles are clear of liens and handle the closing process. Real estate attorneys, required in some states, review contracts and ensure legal compliance. Property managers oversee rental properties for owners, handling tenant relations, maintenance, and rent collection. This sector has grown tremendously as institutional investors have purchased more residential properties. Real estate developers identify opportunities, acquire land, secure financing, obtain permits, and oversee construction of new properties. Finally, real estate investors range from individuals buying a single rental property to massive real estate investment trusts, or REITs, that own billions of dollars in real estate assets.
Let's walk through how real estate transactions actually work in America, because the process is quite involved and differs significantly from many other countries. When someone decides to sell their home, they typically hire a listing agent who helps price the property, markets it through the Multiple Listing Service or MLS, stages it, conducts showings, and negotiates offers. The MLS is a database of properties for sale that real estate professionals use to share listings and facilitate cooperation between agents. Buyers usually work with a buyer's agent who helps them search for properties, arrange viewings, and make offers. When a buyer finds a property they like, they make an offer, which is a legally binding contract if accepted. This offer includes the price, contingencies like financing and inspection, the earnest money deposit, and the proposed closing date. If the seller accepts the offer, both parties enter into a purchase agreement, and the buyer typically has a period to conduct due diligence. This includes getting a home inspection, which usually costs between $300 and $500, and examines the property's condition. The lender orders an appraisal to ensure the property is worth the loan amount. The buyer applies for a mortgage if they haven't been pre-approved already. The title company searches public records to ensure there are no liens or ownership disputes. During this period, either party can back out under certain contingencies without penalty. If the inspection reveals significant issues, the buyer might negotiate repairs or a price reduction. If the appraisal comes in low, the buyer might need to renegotiate or bring more cash to closing. Assuming everything goes smoothly, the parties proceed to closing, also called settlement. This is where ownership officially transfers. At closing, the buyer signs a mountain of paperwork, including the mortgage note and deed of trust. The buyer brings their down payment and closing costs, which typically range from 2 to 5% of the purchase price. The seller pays off their existing mortgage if they have one, and receives the proceeds from the sale, minus their agent's commission and other fees. The title company records the new deed with the county, making the transfer official. The entire process typically takes 30 to 45 days from offer acceptance to closing, though it can be faster with cash buyers or slower with complications.
Since we mentioned mortgages, let's talk about financing, because this is absolutely critical to understanding American real estate. The vast majority of Americans buy homes using mortgages. In fact, about 65% of homeowners have a mortgage. The standard mortgage in America is a 30-year fixed-rate loan, which is actually quite unique globally. This means the interest rate stays the same for the entire 30-year term, providing payment stability. To qualify for a mortgage, buyers need several things. First, a decent credit score, typically at least 620 for conventional loans, though FHA loans can go lower. Second, proof of income and employment, usually requiring 2 years of tax returns and pay stubs. Third, a down payment, traditionally 20%, though many programs allow as little as 3 to 5% down. Fourth, a debt-to-income ratio, usually below 43%, meaning your monthly debt payments, including the new mortgage, shouldn't exceed 43% of your gross monthly income. Finally, cash reserves to cover closing costs and sometimes several months of payments. The mortgage market is backed by government-sponsored enterprises, or GSEs, like Fannie Mae and Freddie Mac, which buy mortgages from lenders, package them into securities, and sell them to investors. This system provides liquidity to the market, allowing lenders to make more loans. The Federal Housing Administration, or FHA, also ensures loans for buyers who might not qualify for conventional financing. Interest rates are crucial to the real estate market. When rates are low, more people can afford to buy, driving up demand and prices. When rates rise, affordability decreases, which can cool the market. The Federal Reserve influences these rates through monetary policy, though they don't set mortgage rates directly.
The American real estate market is constantly evolving, influenced by economic conditions, demographics, technology, and policy changes. Supply and demand are fundamental. For years, the US has faced a housing shortage, particularly in desirable markets. Strict zoning laws, lengthy permitting processes, rising construction costs, and labor shortages have constrained new home building. Meanwhile, demand has remained strong, especially among millennials reaching their prime home buying years. This imbalance has driven prices up significantly in many markets. Location remains the most important factor in real estate. The phrase, location, 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 exists for a reason. Coastal cities like San Francisco, New York, and Los Angeles have some of the highest property values in the country, while housing in rural or declining areas can be remarkably affordable. Remote work, accelerated by the pandemic, has allowed some buyers to relocate from expensive urban centers to more affordable areas, creating new hotspots in places like Austin, Nashville, and Boise. Real estate cycles are real and inevitable. Markets go through periods of expansion, peak, contraction, and recovery. The 2008 financial crisis, triggered largely by real estate speculation and subprime lending, serves as a stark reminder of the risks. Prices plummeted, foreclosures skyrocketed, and the economy entered a severe recession. The market has since recovered and even exceeded previous peaks in most areas, but the memories of that crash still influence policy and lending standards today. Technology is transforming the industry. Online platforms like Zillow, Redfin, and Realtor.com have made property search transparent and accessible. Virtual tours and 3D walkthroughs became essential during the pandemic and remain popular. iBuyers, companies that use algorithms to make instant offers and buy homes directly, have introduced new competition, though some have scaled back after challenges. Blockchain and cryptocurrency are being explored for property transactions, though widespread adoption remains distant. Real estate has long been a cornerstone of wealth building in America. Homeownership allows people to build equity rather than paying rent, and property values generally appreciate over time. The tax benefits are significant too. Mortgage interest is tax-deductible, property taxes are deductible, and there are capital gains exclusions when selling a primary residence. Beyond personal home ownership, real estate investment takes many forms. Rental properties provide monthly income and potential appreciation, though they require active management or the cost of hiring a property manager. House flipping involves buying undervalued properties, renovating them, and selling for a profit. Popularized by countless TV shows, but quite risky in reality. Real estate investment trusts, or REITs, allow people to invest in real estate without directly owning property. These are companies that own income-producing real estate and must distribute 90% of their taxable income to shareholders. You can buy REIT shares just like stocks. Real estate crowdfunding platforms have also emerged, allowing smaller investors to pool money for commercial or residential projects. Institutional investors have become increasingly prominent in residential real estate. Large firms have purchased tens of thousands of single-family homes to operate as rentals, a trend that's controversial because it can drive up prices and reduce homeownership opportunities for regular buyers.
The American real estate business faces several significant challenges and controversies. Affordability is the biggest issue. Home prices have risen much faster than wages in most markets, pricing out many would-be buyers, especially first-time buyers and younger generations. The median home price in America is now well over $400,000, while the median household income is around $75,000, creating a concerning affordability gap. Racial disparities persist in real estate. Historical practices like redlining, where certain neighborhoods, primarily Black communities, were denied mortgages and investment, created wealth gaps that persist today. The homeownership rate for white Americans is about 74%, while it's only 45% for Black Americans and 48% for Hispanic Americans. The commission structure is under scrutiny. In 2024, the National Association of Realtors settled a major lawsuit that could fundamentally change how agents are compensated, potentially decoupling buyer and seller agent commissions and making the system more transparent. Short-term rentals through platforms like Airbnb have created tensions in many communities. While they provide income for owners, they can reduce long-term housing supply and change neighborhood character, leading many cities to impose restrictions. Climate change increasingly affects real estate values and insurance costs. Properties in flood zones, wildfire-prone areas, and coastal regions face rising insurance premiums or difficulty getting coverage at all, which impacts values and affordability. Looking ahead, several trends will likely shape the industry. The housing shortage will persist unless policy changes make development easier and faster. Some experts estimate the U.S. needs several million more housing units to meet demand. Millennials and Gen Z will continue driving demand as they reach peak home buying ages, but their preferences differ from previous generations. They often prioritize walkability, sustainability, and amenities over sheer size. Suburban and exurban areas may continue growing as remote work remains more common, though some return to office mandates are reversing this trend. Climate considerations will increasingly influence where and how people build, with more focus on resilience and sustainability. Technology will keep disrupting traditional models, potentially making transactions faster, cheaper, and more transparent. Affordable housing will demand more creative solutions, whether through policy changes, new construction methods like modular housing, or different ownership models like community land trusts. The commercial sector faces its own upheaval, with office space in particular struggling as remote work reduces demand, while industrial space thrives with e-commerce growth.
The American real estate business is complex, enormous, and deeply intertwined with the broader economy and people's lives. It's where most Americans hold their wealth, where millions work, and where policy, economics, and individual dreams intersect. Whether you're looking to buy your first home, invest in property, or simply understand this crucial industry, remember that real estate is ultimately about more than just transactions. It's about communities, stability, and building futures. If you found this video helpful, please give it a thumbs up and subscribe to MythicVista for more deep dives into important topics. Drop a comment below with your questions or experiences with real estate. And remember, if you're making real estate decisions, always consult with qualified professionals in your specific market. Thanks for watching, and I'll see you in the next one.